I had to unmute. Hi, this is Nick Cacco from BMA. Happy New Year to everyone, and welcome to our first 2023 BMA Lean Accounting webinar. Hold on, I need to make sure I'm sharing my screen. All righty. All right, so first thing is the traditional technical check. Can you see me? Can you hear me? Can you see my screen? Please put something in like the question pane. Answer yes, so that I know everything's working. Okay, I got a few responses, great. Okay, so the other administrative task, again, if you've attended webinars in the past, you understand what to do. If not, submit your questions in the question pane. I will take a look at them probably while we're doing the polling questions and then also answer them at the end. If you're attending the webinar live, you can download a copy of the presentation in the handout pane. If you forget to do that, or if you are watching a recording of the webinar and you want to get a copy of the presentation, just send me an email. I'll be glad to get it. The final piece is also the continuing education credit for certified public accountants. You must answer 3 of the polling questions. There's actually going to be 5 today. And you have to be logged into the event for 50 minutes. Hold on one second. I'm just looking at the questions. You have to be logged into the event for 50 minutes. And if you'd like a certificate, please send me an email and I'll get one out to you. Even if you're not a certified public accountant and you want a certificate of attendance, I'll be glad to send one to you. Excuse me if I sound a little bit funny today. I'm battling a cold and congestion, typical winter thing. Anyway, let's get moving. All right, so what would I like you to get out of this webinar? First of all, to understand the problems that standard costing systems create in lean companies. I'm going to show you lots of examples of how standard costing can lead to poor operating decisions in lean companies. And so it's really good for you to understand that for your own company. Then I'll basically review the solution to this problem is lean performance measurement system. Then we'll do wrap up and questions. This is the first of like 3 related webinars. The February webinar is going to be on standard costing and poor financial decisions. And the March webinar is going to be on just how do you sort of eliminate standard costing. All right, so let's do the first polling question. It's just the basic attendance question. Give everybody a little bit of practice. Hold on one second. I'm having a problem. Hold on, I'm having a problem with my control panel here. Hold on one second. Let me just escape. All right. Can you guys still hear me? Okay, hold on. All right, so let me get the poll going here. So this is going to be attendance check number 1. And it's just basically, are you paying attention to the webinar so far? The questions, there's going to be a few polling questions today. They're going to be related to answering a question based on a certain situation. So these will be coming up shortly. They're not going to be all just, yes, I'm attending today. All right, I'm going to close the poll. Not going to share the results. And let's move on. All right, so let's review the problems that standard costing systems create in lean companies. And this is really interesting because I personally, as a CFO, sort of learned this the hard way. As a young CFO with not a whole lot of experience, what some of these problems can cause and how it can really, I'm going to go extreme here, it really can twist an organization around. So a few random thoughts. First of all, I think the topic of standard costing in lean organizations is somewhat misunderstood. And I think it really relates to what part of the company you work in, okay? You know, if you're in accounting and finance, you really understand what a standard costing system is, and you're sort of the steward of the system, you know. But if you're in operations, you might have a different view of it. You may not, you probably don't, you may not really understand it. You might see numbers, but you don't know where the numbers come from or how they're calculated. And for example, you know, sales and marketing. I've worked in many companies over the years where, you know, sales and marketing people, they want a standard cost so that they can calculate a price. And by golly, you know, if you tell them it's going away or it's changing, they sort of sometimes take a fit over the cost changing. So you have these different views. Now, think about standard costing from a lean viewpoint. And what is lean? Lean is about problem solving. And so in order to deal with standard costing in your company, you must approach it from a lean viewpoint. Okay, so there must be you have to understand the problems. The problems of standard costing must be understood throughout the company, and there must be a process and a plan to eliminate the problems or solve the problems. That's the way to look at it. That's the best approach to take. I will say here, and I'll repeat it probably a few times over the next 3 webinars, you know, this is not a quick fix, okay? It takes a while to solve the problems. And quite frankly, it's really unique in every company. I've been fortunate to work in many companies over the years, and you know, what I'm giving you is sort of general approaches that I have seen work or that I have helped companies use. All right, so the first problem is that a standard costing system is deeply embedded in a company. All right, and it's standard. I like to say that these are like the tentacles of standard costing. In most companies, not all, but most, the standard costing system is integrated into the ERP system. That in itself makes it complicated. Why? Well, let's start from the top. Standard costing, one of its primary functions is to value inventory for financial reporting purposes. Now it does a really good job with that. And it sort of automates everything, okay? That's why you have overhead absorption. Every time you produce a product, you put it into finished goods inventory, it absorbs that overhead and takes it off the income statement and puts it into finished goods inventory. Likewise, every time you, you sell, takes it out of inventory, puts it in cost of goods sold. So it sort of works automatically. Going to the right, because its standard costing is integrated in the ERP system, it requires the production reporting transactions. And the easiest way to describe this is that the more detailed your product cost information is in terms of the detailed rates and overhead rates and production reporting steps, the more transactions you're going to have. You have to set standards, okay? And again, the complexity of setting standards is sort of set up based on the idea of creating an accurate product cost. Lots of overhead rates, lots of product cost rate, lots of rates, lots of labor rates, lots of routing steps, things like that. Standard costing is also, the information in standard costing is also used in measuring operating performance, primarily absorption and variances, which we're going to talk about today. The product cost information can be used to analyze profitability. Mentioned sales and marketing, how much are we making on this product if we charge this price? You can look at it from the company perspective. What's the standard margin for the month? And finally, it's the role of accounting. Okay, if you have a standard costing system, you probably have cost accountants who are dealing with all this information. So, there are solutions to all these issues from a lean accounting viewpoint. Lean performance measurements replace the traditional standard costing measurements. Value stream income statements and box scores are used to analyze profitability, not product cost. Transaction elimination. There are opportunities to reduce the number of production reporting transactions and make things a little bit easier on everybody. You can set fewer rates. You can use lean inventory valuation methods. And basically, the idea of a lean management accounting system changes the role of accounting. What I like to say is you want to take your cost accountants and turn them into lean accountants. So there are solutions to all of these issues, and this is what we're going to be talking about over the next 3 webinars. Now, you can see that this is quite complex. So what do you do? What do you do in a lean company when you have a complex problem? You break it down into smaller problems to solve rather than just looking at it as one massive problem, which is going to take a long time to solve. And so in general, what you see here is the way to break down looking at standard costing in your company to identify, how to solve the problems in each of these 6 areas. And if you really study how standard costing is used, you will come up with ways to solve the problems. You can also look at standard costing system from a waste viewpoint. okay, that there's waste in the standard costing system. First of all, defects. The information that it produces is not relevant or reliable to the users. This is very true in a lean company. I mean, I've worked in enough lean companies, and I know enough lean people that they just sort of go like this when it comes to standard costing information. They don't want anything to do with it because they know it doesn't help them. You can talk about overproduction. Information is produced and not used. I have periodic conversations with an operations manager in a lean company, and we first started talking because he said, accounting, they send this detailed variance and overhead absorption report every month, and we ignore it. We don't even use it. We don't, and to make it worse, accounting never asks any questions about it. So accounting is producing information and it's not being used. That's overproduction. If you think about the purpose of information is to sort of analyze it and or make decisions, the long feedback loops in a standard costing system really prevent doing any kind of good root cause analysis, especially if you get a monthly variance report or a monthly absorption report. Can't do you could explain what happened. You can say, here's the reasons why overhead was underabsorbed for the month, but you can't do anything about it because everything has already happened. And that's not what you want to do with information. There's the neglect of talent, human talent. I like to, in operations, you have people that have to perform ERP transactions when they're better suited to actually build the product that customers want. In accounting, you have trained accounting professionals who are diving into details and they're sort of like what I call Excel jockeys. They're taking, and I actually know some of these people, they're very good accountants, but they spend all their time on spreadsheets, sort of taking all this standard costing information and massaging it and building reports and trying to analyze it. When what they should be doing is being involved on an operations team to drive improvement. There's handoffs of information between systems and people. Okay, you think about it. You report transactions in an ERP system. It goes into the general ledger. Accounting takes it and puts it into Excel to get a report. That's all handoffs of information. Batch inventory, batch processing. The setting of the rates on an annual basis is a big batch process. And by the way, it's not very accurate because you're trying to predict the future. Then there's the human motion of searching for the information. I also sort of fold into the motion waste the number of meetings, emails, office visits on standard costing information that, questions and answers. Then there's excess processing, which is all of the detailed transaction reporting, okay? So again, if you really want to sort of frame, the state of standard costing in your company, look at it from a waste viewpoint. Where is the waste? And you'll see a lot of it. So migrating from standard costing, you think about standard costing, I like to say there's three primary uses in a company. Values inventory. It can be used to analyze profitability. It can be used to analyze performance of operations. What you want to do is first take it out of the profitability analysis and the measuring operating performance. What I like to say is that a lean management accounting system is standard cost free. You don't want standard costing information to be used in the lean management accounting system. And unfortunately, when you have an ERP system and you have a standard costing standard costing system integrated with your ERP, that's sort of the way it is. Your management accounting system is based on standard costing. So this is what you're trying to do is step one, eliminate this, okay? Get it out of management accounting. And how do you do that? That's pretty much using lean accounting box scores. Now for inventory valuation, that is a separate issue. That is a financial accounting issue. Like I said earlier, you have, standard costing does a good job of valuing inventory, but there are other opportunities, but we're going to be discussing those in March. Okay, so let's look at examples of poor operating decisions. Now I'm going to, the first three are going to have questions that you have to answer based on the scenario I explained. There's no right or wrong answer, but I just want to get some interaction and I want you to put your thinking hats on about how you would view this. All right, so purchase price variance, which is a very common key performance indicator. For those of you who may not be familiar with what purchase price variance is, it measures the difference between the standard cost of a product that you buy and the actual price that you pay for it. Okay? So here's the situation. But you're the purchasing manager, and the purchasing department's key performance indicator is the purchase price variance. Right? So you have to order some material, raw material A, from a supplier. The standard cost is $20 per unit. The value stream needs 10 units a week. Okay, and the value stream is lean. The supplier quotes you $22 per unit for $10 a unit, 10 units a week. Then the supplier makes you an offer. And the supplier says, if you buy 3 months of units in one purchase, I'll sell it to you for $14 a unit. All right, so now time for you to answer the question. What would you do? Would you buy the 10 units per week at $22? Would you buy 3 months of units at $14? Would you change the standard, or would you change the KPI? I'm watching the percentages. I'll give you about 30 more seconds to vote. And I'll show the results here for this, because this is exactly what I wanted to do with the polling questions. All right, you got about 10 more seconds to vote if you haven't voted yet. I'm going to close the poll. I'm going to share the results. All right, so interesting. So you know, most of the people would buy the 3 months at $14 a unit. The second most responses would change the KPI. And then you can see some people said they would still buy the 10 units at $22. The purpose of the question and looking at the answers is it puts, if this were you, you are in a bind. Why are you in a bind? What the best thing to do for the value stream is 10 units a week. But that's what they need, and that's the lean thing to do. You only buy from your suppliers what you need. You don't want to buy more inventory. But the KPI says, no, you buy 3 months at $14. Now, again, I'm sure you can make the case that there might be some extenuating factors, but just take this for what it's the way I explained it. And that's the problem with a measure like this is you have a traditional measure, which is based on standard costing, but you have lean operations that want to do something different. And it's a no-win situation, for example, for purchasing. So interesting. All right, so let's look at another one. So we're going to talk about overhead absorption. All right, and for those of you who may not understand what this is that the way a standard costing system works is that when you report production, it takes the items that were in raw material or work in process inventory, it puts them into finished goods, and it attaches overhead to the cost of the finished goods. And it does this automatically, but the financial transaction, this has an impact on the income statement. Overhead absorption reduces the expenses, and because it takes the expenses off the income statement and puts them on the balance sheet in finished goods. Okay, item by item, that's how it works. So here's the situation. It's the last week of the month. You are a value stream manager, okay, and your value stream is measured on schedule attainment. Are you producing based on the production plan? And you're on track for the month of January. Everything's fine from that measurement standpoint. Senior leaders, they see that the selling general administrative expenses for January are tracking higher than planned. And they're concerned that they're not going to meet the profit forecast for the month. And we're shipping everything we can ship, okay? That are orders that are due to be shipped. So senior leaders sort of come to you and suggest, hey, what we'd like you to do is you have these orders that are supposed to be produced and shipped like the first 2 weeks in February. What we'd like you to do is produce them in January and just stick them in finished goods inventory. And then when the shipment due date comes in February, go ahead and ship. All right, so that's the situation. So my question is, how would you respond? How would you respond to this request? Would you say, this is a game that doesn't reflect reality and is not lean? You're robbing February to make January look better. What you really should be doing is finding the root cause of your excessive selling general administrative spending. And my job is to meet the schedule. My job is to meet schedule attainment, not to overproduce. And by the way, you can answer more than one here. It's not just one answer. All right, I'm going to close the poll, share the results. Interesting. Actually, all of these answers are valid. I do like the fact that most of you said, find the root cause of the selling general administration SG&A spending. Don't, it's sort of like, don't come to me. It's not my, it's not, I didn't cause the problem. I'm meeting my schedule. It is a game, okay? This idea of, robbing February to make January look better, the problem, here's what happens. So you over-absorb in January, but then you don't have that production in February, and how are you going to make that up in February? It could make, actually, you could over-absorb in January, under-absorb in February, and then for the 2 months, you're net zero as to over or under. Okay, it's a shell game. And I actually learned this as a CFO in one of my jobs where production actually played that game, and then it's sort of robbing one month to make another month look better. Something happened in the next month and they weren't able to produce, and it all came out. Okay, and this stuff still, by the way, this stuff still goes on. Okay, but again, there's a conflict here. Lean is about meeting the schedule, and the schedule is based on actual demand. What does the customer want and when do they want it? If you overproduce, you're building inventory. That's a wasteful activity. And, if you're building inventory or you're building the inventory, but, the question is, do you have orders to ship that inventory? So again, you have a value stream manager who is put in a bind where he's doing the right thing by just producing to the schedule. But, people higher up in the organization, they're concerned about profit, so they go to the easiest thing. That's the whole thing about this, is that this is the easiest thing to do. Just produce the orders, because you can't, even though you could find the root cause of excessive SG&A spending, the money has already been spent. The expenses are what they're going to be. You sort of can't pull the expenses back. The bills have been paid. So this is the easiest thing to do. Let's just go into operations and let's have them do something different. All right, I'm going to hide these results. And we will move on to the final polling. And this has to do with production variances. So again, you're a value stream manager. The plant controller comes out to talk to you about your unfavorable production labor variance, okay? And what she says to you is that she suggests that, why don't you have longer production runs? Because if you have longer production runs, that's going to make your labor variant, the labor variance, more favorable, and that's going to improve the profitability of the company. So I'm going to launch the poll, How would you respond to this? We are make to order, and we balance that, and we balance making to order with the number of changeovers that we do. If we have longer production runs, we're going to build inventory, and it's best to meet exact customer demand and serve them. All right, you got a few more seconds left. All right, I'm going to close the poll. Share the results. Again, these are all valid answers. That, again, it's important to understand, what you have here in this situation is, you have someone in finance who really probably doesn't understand what lean operating practices mean in terms of being make to order. They're just looking at the numbers, and they know that we have a longer production run, we get a better number, and that improves the financial position of the company. And sort of that's sort of the real danger of using standard. Let me close the poll. That's the real danger of using standard costing information for operating measurements or operating decisions. Because in any of these measures that you see here, PPV, overhead absorption, the standard cost, or production variances, it will drive, the only way you're going to make those measures look good is with what I would call, what I say is anti-lean behavior. Okay? And it's just like total opposite of what you should be doing. All right, let's go on to a few more examples. And this one is an actual case study. All right, so what we have here is we have a very small value stream where the first production step is to drill on the CNC machine. It takes 1 minute. They work in a batch of 2,500. Then they do more machining on the lathe, which takes 4 minutes, 6 minutes to grind, inspect, pack, 4 minutes. All right, so let's look in the lower right first. What are the lean performance measures? 6-week lead time, 25 days of inventory, batch size of 2,500, on-time delivery, 82%. Not very good. From a standard costing perspective, the product takes 15 minutes to make. The labor cost is 5. The overhead rate is 300%, so the overhead cost is 15. The material cost is $1.50, so the total cost is $21.50. Now, this value stream can produce 10 units per hour. Why is that? Because the grind operation has the longest cycle time, 6 minutes. And that, because it's the bottleneck, or you can call it the bottleneck or the pacemaker or the constraint, but that dictates how many units can be produced, only 10 per hour. All right, so improvement number 1. In the upper right, first of all, they create a cell. What they did is they took the big CNC machine and replaced it with a smaller drilling machine that they happen to have sitting, not being used. So now it takes 4 minutes to do the drilling. Everything else pretty much stays the same. And by the way, those little people there, it's one person on each operation. Lower right, what happens operationally? Lead time is reduced to 2 days. Inventory is down to 5 days. Batch size is 1 day. On-time delivery is 98%. All really, really good. But from a standard costing viewpoint, it takes longer. The CNC machine was 1 minute. This is 3 minutes longer. And because the total time is longer, it drives up the cost. And let me qualify that. It inaccurately drives up the cost. The costs are the same. You have the same machines. Actually, the drilling machine is less expensive than the CNC machine. You have the same amount of people. What actually happened here, and this was a real case study that from a company that I worked at, is that the accounting people were adamant that this improvement is not good because the cost goes up, but the lean people were arguing, no, look, we're serving our customers better. And the units per hour stays the same because the grind operation is still 6 minutes. And this is something that if you don't understand lean, it's important to understand is that you could slow down a process. I mean, ideally, you want everything to work as close to the bottleneck as possible, which leads us to our next example. There's another improvement, and this is the grind operation where we reduce it from 6 minutes to 4 minutes. So now everything is working at 4 minutes. This reduces the bottleneck time. So now we can produce 15 units instead of 10 units. So again, our lean measures are good. Standard costing is still higher than the current state. Again, it's a good improvement, makes sense, but the standard costing information says no, doesn't make sense. And by the way, just sort of, how much more money are you going to make? You're going to sell 5 more units at $200 a unit or $40 a unit. So you're going to make $200 more an hour. The only additional cost is the additional material of $1.50 a unit, $7.50. So every hour, you're going to make almost $200 more an hour by doing this, which is good. Make-buy decision, okay? So again, you have 2 products in a value stream. You can see product A takes 17 minutes, product B takes 24 minutes, but their rate of flow is the same. It's 10 units per hour because their bottleneck cycle time is the same, 6 minutes. So you can make any combination of A and B, but you can only make 10 an hour. So what happened is this company set a policy, any product with a standard cost, a standard margin of less than 30%, they should outsource. And so you can see that the standard margin of A is about 39%. The standard margin of B is 25%. So what happens? What happened? B was outsourced, okay? When you outsource a product, you actually increase the material cost. So instead of spending $42 on the raw material for product B, you're spending more for a supplier to make product B for you. Then when you look at the overhead, you'll redo the overhead rates. Product A has to have a higher overhead rate. And eventually, product A's standard margin is less than 30%, sorry, and product A gets outsourced. The lesson, actual costs are not related to the time to produce a product or deliver a service. All right, so let's do polling question number 5. Really, really fast. This is just a basic attendance check. All right, I'm going to close that poll. I'm not going to share the results. So what's the solution? Solution is a lean performance measurement system, okay? So what is a lean performance measurement system? You know, it's measurements, visual display of the measurements that are used in daily, weekly meetings and are used for lean problem solving. Lean performance measurements are not just about reporting numbers. They're used to solve problems, okay? They're very active in terms of their use. So what I'd like to do is just do a basic review of the measurements. What should you be measuring? So first, think of 3 cycles. You have daily measurements, and they serve a specific purpose. They're measured at the cell. You're measuring daily performance standards. How much were we supposed to produce? How much did we produce? What you're trying to do is understand the problems that are occurring in the daily work of the process, whether it's manufacturing or service or an administrative process. So the idea is, you know, and we discover the problem, what do we have to do to react to that problem? You have weekly measures that are typically looked at the value stream level. They're to measure improvement over time. They're used by value stream teams in a weekly meeting. And it's really the combination of all the improvements that are going on and the lean operating practices that are being employed that drive the improvement in these measures. Then you have the monthly measures that are strategic in nature, used by leaders to understand, is our lean strategy on track? So just quick review, what should you be measuring on a daily basis? So you have 7 basic categories of measurements: productivity, quality, delivery, flow, cost, lead time, safety, morale. That might be 8. Okay, it's 8. You know, productivity, schedule attainment. What's the plan? Did we meet the plan? Measure defects or first time through. That's going to be the best way to understand what is causing the quality problems. Delivery is also schedule attainment. If you have a production process, you would want to look at the actual work in process compared to the planned work in process. How many units at any point should we have in process? When you're looking at cost, you should be looking at the drivers of cost. Okay, for example, overtime hours. Why are we working overtime? If we're staffed correctly, you know, and if our demand is normal, why are we working overtime? Lead time, you can look at changeover time. And then there's the incident rate for safety and cross-training for morale. On a weekly basis, again, these are looking at improvement over time. So, you know, productivity, sales over hours worked. The more hours that you work, or the more people that you have, you should be getting more product out the door. You want to look at the defect or first time through rate for the value stream as a whole, not how do we improve that? On-time delivery to customer request date. If you're in manufacturing, you look at days of inventory. For cost, you look at cost as a percentage of sales or actual cost per unit. You'd look at the average lead time. And again, you can have an incident rate, excuse me, or continuous improvement participation. On a monthly basis, the measures are very similar to the weekly measures, but they're looked at as the company as a whole or the business unit as a whole. Productivity, sales per person, the denominator of the number of people, all the people that work in the company or in the business unit, not just operations. Quality, it's really difficult to measure quality at a high level, okay? Because if you're looking at trying to take all the defects and create one number, it's not going to mean much to senior leaders, like what's the overall defect rate. They can't do anything about it because the first question they're going to ask is, what are the root causes? And you get the root causes with the daily measure. Now, some companies, they use returns or something like that. Delivery, on-time delivery in total to customer request date. You can use days of inventory. Cost, you would look at cost as a percentage of sales, like your labor, overall total labor cost is a percentage of sales. Average lead time, and then incident rate and things like retention rate. You can create these measures using a linkage chart process. This is what a linkage chart looks like. And you sort of work from left to right. You define the strategies for the company. How are we going to measure at the strategic level? Once those are decided, what are the goals of the value stream? And how is the value stream going to measure? At one level, for example, value stream measurements, you're measuring the distance from the goal. Then you understand the critical success factors for the cell. What are the goals and how are we going to measure? So the idea is to link goals with measures. It's also to create relevant measures in every part of the business or every part of the value stream. You want the people who are being measured, or the areas being measured, that they can act on understanding problems and issues. The linkage chart development process sort of follows a PDCA cycle. When I work with companies, we do like a 2-day Kaizen event. Okay, we actually create that linkage chart using Post-it notes on a board. We identify the measures. We figure out how the measures are calculated. And we actually try to go out and gather the data to understand it's fairly simple and easy to get the information. Then what you do is you pilot the measures. So daily measures, you pilot for 30 days in daily huddles. Weekly measures you look at for maybe 4 to 6 weeks. The monthly measures you may look at a bit longer. The pilot phase is really about, do the measures that we have developed, are they helping us identify problems and issues? If the answer is yes, it's a good measure. If the answer is no, then you pretty much have to adjust. And typically when you do a linkage chart, you'll have to adjust some of the measures, but not many. So wrapping up, and if you have any questions, get them in, because we might have a few minutes to answer questions. So first of all, at the end of this webinar, it's going to pop up to complete a survey. Please do. Also a reminder, if you want a continuing education certificate, send me an email and I'll get that out to you in a few days. So basically, solving the performance measurement problem. You want to start using lean performance measurements. You have to sort of put the new in place and get people to understand how to use them and learn how to use them before you sort of say that we're going to stop. Okay, we're going to stop using variances and absorption. Now, I do want to say one thing here. You really can't use both at the same time because they could, again, give you conflicting information. You want, lean performance measurements that the teams own the measures. They use them. They're responsible for reporting them. And really what they're supposed to do is not just report the numbers, but their job is to escalate the problems and issues that they can't solve. You can reduce transaction reporting and rate setting. What you really have to do, if you have the standard costing system in place, you're still going to get the variances and the absorption numbers on the financial statements. It's sort of natural. But you have to ignore them. And people have to understand we have to ignore these numbers. Actually, what I did as a CFO is I took all those variances and absorptions. I just put it, when I produced the financial statements, it all just was in one number. Okay, and the senior leadership team understood. We went through a little bit of training and education about what these numbers really meant, because we had lean performance measurements in place, and we sort of just all agreed, we're going to ignore this number. Who needs to be involved in this? Accounting, operations, and the leaders of the company. Okay, again, you're trying to solve a problem that the standard costing performance measures don't work well in a lean company. So people have to understand what the problems are. You have to sort of say, here's the current state, this is the future state. What's the plan? How are we going to get from the current state to the future state? Get the people involved, okay? Especially the people that are using the existing standard costing information in terms of operating decisions. You got to get them involved in it. And by the way, just a little tip, if you have lean people, they're going to be all on board with this really, really fast. Okay. So that takes care of the presentation. Just want to let you know, here's the upcoming, in chronological order, here's the upcoming lean accounting events. The February webinar, standard costing leading to poor financial decisions, February 8th. Here's how to register. You can also go to the maskell.com website and look at events and register there. February 10th, from 2 o'clock to 3 o'clock US Eastern Time, I'm going to be doing the book launch of the second edition of the Lean CFO. It's free to attend. You just have to register on Eventbrite. When you register, you'll get the Zoom link. It's going to be a fun event. My friend Karen Ross is going to be the host. I'm going to talk about the book, and we're going to have a few people that are actually current customers of mine are going to be talking about the book and how it influenced how they're running their business. And then in March, we're going to do the Eliminating Standard Costing webinar. So please register for these events. We'd love to see you there. All right, so any questions? So there's a couple questions. One is that generally accepted accounting principles is used for financials, which eventually determines the profit that impacts the stock price. Yes, that is correct. And generally accepted accounting principles, their main purpose is to create a set of financial reporting guidelines so that anybody can compare company A to company B. I mean, you have to sort of follow the rules to report so that you can see, oh, this company's doing better than another. And especially public companies, that's going to determine the stock price. But, generally accepted accounting principles should not be used inside the business to analyze the business. That is really the point of lean accounting. So anyway, thanks for that question. If any of you have any other questions, please feel free to email me and we can talk about them anytime you want, either via email or on a quick chat. All right, so we're at the top of the hour. Thanks for attending. Hope to see you on these other online events. And if you've listened to the recording, you have any questions, please let me know, and we'll see you soon. Have a good day.